We've got to have a discussion about real value in crypto and what I would call legal fiction. I would propose that real value in crypto is actually tied to utility, just like it is in the real world. A legal fiction, on the other hand, is an assertion we accept as being more true than it really is to arrive at a desired legal result. Unfortunately, what happens in crypto is that the actual value of a project, its actual utility, often turns out to be of let's call it ambiguous legality. So we invent some legal fiction to make it seem like the project derives its value not from the possibly illegal thing, but from something else entirely, some false narrative. Yet we still want to peg that value on the outlaw utility. This, of course, is ridiculous and not sustainable, but it doesn't have to be this way. True decentralization and self custody, like we saw in Bitcoin, like we see today in Cardano, mean that you don't have to engage in these unsustainable mental gymnastics. Ready? Let's go. Today, we're going to discuss Vitalik's recent observation that really probably is the truth about project tokens, a look at equity versus tokens in Cardano venture funding, an interesting point about crypto utility that isn't illegal, LBRY announcing their death at the hand of the SEC, and Endmaker's Rogue Galaxies bringing something new and refreshing to Cardano games. If you totally understood that the once upon a time means that this episode is about fiction and false narratives, or if you're finding value in these videos each weekday, please consider delegating to the Army of Spies stake pool, ticker AOS. I will admit, I often make little jokes about Ethereum glorious leader Vitamin Butters. However, in this case, I think he is exactly correct. He says the notion of governance rights as a narrative for why a token should be valuable is pathological. You're literally saying, I'm buying this asset because later on someone might buy it from me and a bunch of other people to twist the protocol toward their special interests. So what is Vitamin talking about here? He's talking about this phenomenon where projects, I don't think it matters here even if we call them projects, platforms, or protocols, but these projects, especially our crypto DeFi projects, they're often engaging in some kind of activity that in any other context, any normal person would probably call a violation of some securities law or reg, some commodities law or regulation, or some banking law or regulation. It's usually always a violation of one or more of those things. So they can't come right out. These projects can't come right out and say, hey, we want to sell you tokens, and the tokens entitle you to some of the revenue from one of these activities that in a traditional context would be illegal. Like they don't want to do that. That looks bad. They know that's not a good idea. So instead, what they do is they sell you a governance token and they tell you, hey, this governance token is just about voting. There's no revenue streams from the platform's activities, the protocol's activities. That's not what this is about. This is just about you buying the right to vote or earning the right to vote. But somehow there's always some kind of a transfer of value. You have to do something to get these tokens. You have to either do something on their platform, which creates revenue for somebody, or you have to buy the tokens. But somehow you're giving them something in exchange for the tokens. So they have to say it's just about governance. You're just buying the right to vote, which is kind of laughable because if you look at the voting rates in most sort of modern Western developed countries, people kind of look at voting as more of an obligation and duty rather than something they would pay for, which is kind of ironic because in a lot of cases, the ancestors of those same people, probably had to fight bloody revolutions just for the right to vote. But in modern developed countries, it's often seen as more of something like an obligation. And if people had to pay to vote every time, voter rates would probably be even lower, which makes it improbable that the value of these tokens is really tied to that right to vote. It doesn't really make sense, right? So we know this isn't really what's going on. This is kind of like this legal fiction thing this assertion that's not really as true as we're pretending it's true, because we want to arrive at this legal destination, this legal conclusion, this legal result that we're not selling off the revenue streams from this platform or protocol or project's activities. We're not selling off those revenue streams because that sounds a lot like something that gets you in trouble with regulators. We're just selling off these voting rights, or we're giving out these voting rights in some way. But just to show you how ridiculous this false narrative, this legal fiction is, Vitalik elaborates on it. He says, as a regular individual, pay $500 to get a 0.0001% chance to influence the outcome of some votes is just not a good trade. The only people for whom it is a good trade are multimillionaires and hedge funds, including attackers. Of course, that's a ridiculous and unsustainable narrative to hold up the value of these tokens, and multiple people were quick to point that out. In fact, here you see Vitalik using his response to somebody else to respond to this other person who pretty much said the same thing, but more succinctly. This poster says, I think it's more like one day we will be able to extract rent via the governance rights, to which Vitalik responded, at least to the other person, and now to this person. I would say in that case, the valuation story is based on the existence of that fee switch. Many projects have no conceivable fee switch, but yeah, I get that point. So this is the real reason. The false narrative is just covering up this actual source of value right here. The whole thing with these tokens, people are acquiring these tokens. They're trading something of value to get their hands on these tokens because they all believe that one day there will be a vote. Hey, how about we throw some of that revenue stream from the project to ourselves? How about we grab some of that revenue for ourselves, the governance token holders? That's the real narrative. That's the real utility. That's the real reason everybody wants governance tokens, because they know they can one day have a vote where they vote, hey, throw all that revenue my direction. Vitalik does point out something important here, though. It has to be feasible. There has to be a team around to actually make that happen, to actually rework the project architecture, if it's possible. I mean, he's pointing out that it's not a guarantee that there is a conceivable way to move the fees over to the voters. And here's where the projects have kind of an advantage over their users, over the user base, over the community. The community is always assuming, hey, they're just not talking about us getting the revenue or some small slice of the revenue because of the regulators. But that's not a guarantee. If they're not talking about the token holders getting some slice of the revenue, maybe it's not really very feasible. Vitalik straight up saying right here, many projects have no conceivable fee switch. He doesn't really believe, he believes in the case of many projects that they won't be able to give the token holders any portion of those fees one day, or at least, I think he's implying that at least they wouldn't be able to do that without some gigantic, huge re-architecturing of that whole protocol. And I know what you're thinking. You're thinking, no, man, it's easy. You just designate some address and some portion of the revenue goes to that address, and then you just distribute that out to all the token holders. But I mean, there are other considerations in the architecture of these protocols. There are issues related to game theory and all kinds of other things. And in some cases, I do believe that a lot of these projects will never get to the point where these token holders, who obviously think they're going to get some slice of the revenue, I'm not sure in the cases of many of them that they'll ever get to that point where the token holders ever get to extract rents, as this poster put it. Also, on a practical level, somebody's actually got to do it. Somebody's actually got to rework the protocol to make all these things happen. And there's no guarantee that the team is actually going to be around if all of their team tokens have already vested and been unlocked for them. They might be out of there. So the token holders might be out of luck. So you have to ask the question, if that's the case, why do we even have these governance tokens? Why do we have these fungible tokens related to these projects? The reason we have these fungible tokens related to these projects really is so that the founders and the team and the investors can extract value from the project. That's the reason the fungible tokens are always attached to these projects. If the projects were really, let's say we have a DEX. If the DEX project was really just about providing utility to the ecosystem to more cheaply swap tokens. If that was the whole utility, you would not need any kind of fungible governance token for that project. The real reason why those fungible governance tokens exist is so that the founders and the team can get paid, and so that their VCs and their other investors can get paid. We'll talk a little bit more about this in the context of the decision that projects have to make between giving VCs project tokens versus giving VCs equity positions in the lab entity that's actually the team entity behind the project. But for now, we'll just say the real reason every single one of these projects has fungible tokens are so that the founders and the team and the investors can get paid. But there's another way to do this. We already know there's another way to do this. In fact, this isn't the original way to do this. The original way to do a crypto project is the way that Bitcoin was done, the very first crypto project. Satoshi didn't pre-mine himself a bunch of tokens. Satoshi created the protocol, pushed it out there, and then he participated in the project. Can you believe it? The founder actually created the project, published it, put it in the wild, and then he used the project, he used the platform, the protocol, just like anybody else could have. And that's how Satoshi made his fortune. Although you could argue, since he never really spent his fortune, maybe we shouldn't call it a fortune. But Satoshi just created the protocol, brought it to the public, and then he used it just like anyone in the public could have used it. Satoshi also did two other very important things that are very different from the way projects do them now. He didn't have any kind of centralized front end, and he didn't do anything that required you to give up custody of your assets. These two things are important. Not having a centralized front end is important. If he had had some kind of a website interface for the Bitcoin protocol, if the way you access the Bitcoin protocol was by going to his website and then you could like send your Bitcoin back and forth, then regulators would have figured out who was running the website. They would have found the Satoshi Labs entity that, of course, didn't exist in reality, but they would have found that entity, and that would have been the end of Bitcoin. Satoshi didn't do that. So he didn't have to worry about regulators. There was no need to create any kind of a false narrative because there was no centralized front end, which means there was no discoverable Satoshi Labs entity that would have caused him to be the subject of regulatory enforcement. He also didn't require that anybody give up custody. There was nothing in Bitcoin that required you to like deposit your Bitcoin, with Satoshi Labs so that Satoshi Labs could, do something with your Bitcoin and they could make like $10, and for every $10 they make, they give you back 9, but they keep 1. He or she was not trying to do anything like that. So again, he didn't have to have any kind of a centralized entity. There didn't have to be a Satoshi Labs. And also, when you don't take custody of other people's money, you don't start stepping on a lot of these banking regulations. Because you think about it, anytime in the real world, anytime someone has custody of someone else's money on a commercial basis, that's under some kind of regulatory regime, some kind of banking regime or something else. You're some kind of an escrow agent or something, but it's usually very highly regulated anytime you are taking custody of someone else's assets. Satoshi didn't do any of those things. He didn't take custody of assets. He didn't create a centralized front end. And there was no team allotment for Satoshi. There was no pre-mine. All of these things meant that he or she didn't have to engage in any of these legal fictions or false narratives because there was no identifiable Satoshi. to be a regulatory target. There was no Satoshi Labs. There was no centralized front end. Can you imagine if a project just came out right now? Can you imagine how differently they would build their project if their intention was to do what Satoshi did? Just build the project and say, hey, this is not as good for us because we're not going to have this giant team allotment that we get to, rain down on you and use you users as exit liquidity. So not as good for us, but we're just going to launch this protocol and we're going to use it and make money on it just like you are. Can you imagine how different the protocols would look? All of this stuff they're doing, all this custody stuff, all of the centralized lab entities that say they're different than the platform and the protocol and the DAO, all of the governance tokens, all of this only exists for the teams and their investors to more efficiently extract value from the projects. Everything would look a lot different if the way we develop projects was not, as sort of like a venture capital project. If we develop projects more like Satoshi did, everything would look a lot different. And you could argue that many fewer projects would get developed, and that's probably true. But I mean, the flip side of that coin is, how many DEXs do we really need? How many other types of protocols do we really need? I mean, they exist, but how much utility are people really getting out of, the 11th iteration of each specific type of DeFi platform? Speaking of VC funding in crypto, you'll probably remember all the drama in that Twitter space where Bison Coin sort of forced Liquid to reveal early that they had received some VC funding. Here's the official announcement for that seed round. Liquid Labs says, "Good day, Cardano community. We completed a $2.7 million seed round led by C Fund, Shima Capital, also involved Shima Capital, Animoca Brands, Autonomy, GenBlock Capital, OptimFi, Double P Group, and BitTrue Official. Our team thanks them for supporting Liquid and Cardano DeFi." So, of course, Liquid was kind of famous among, sort of Cardano projects for this distinguishing feature that it seemed like it had largely been funded by Catalyst and not by, any kind of VC funding. So I think a few people were taken a little bit by surprise when they heard that there was some VC seed round for Liquid. But actually, when you think about this, $2.7 million, it sounds like a lot of money in the context of like an individual, a single person having $2.7 million. But if you think about it in the context of a regular tech startup doing a seed round of $2.7 million, this is an amount of money that a regular tech startup would burn through really fast. Like $2.7 million in a regular tech startup disappears very, very quickly. If you're doing any kind of real software development whatsoever, that amount of money is usually going to disappear very, very quickly if you've got any kind of a sizable development team. But I think the more interesting thing here is that it turned out this was an investment in the tokens of the project and the team allotment of the tokens. So this brings up the question, what is better? What is better for a Cardano project VC round? Let's just assume that there are going to be VC rounds in Cardano projects, because there is going to be VC funding of Cardano projects, no matter what anybody thinks, whether it's good or bad. But if we ask the question, what's better? Should Cardano projects have the VCs invest in their tokens or in the equity of the lab entity? So there are a couple things here. If they invest in the tokens, the community of the project always fears that the VCs are just going to use them as exit liquidity. They're going to dump those coins on the community in retail as soon as possible. That's the big fear of the community always. However, if we say, okay, so the alternative is the VCs invest in the equity of the lab. If that's the case, then that means the VCs have been convinced that a lot of the value in the project is going to accrue to the lab. That if that's the case, you'd assume that means the team is trying to also make the value in the project accrue to the lab entity. The lab entity is something that the token holders don't have a stake in necessarily. They don't hold equity in the lab entity. They hold tokens in the ecosystem. So we're kind of caught in this catch-22 here. If you let the VCs have tokens, then everybody fears they're going to dump those tokens on retail, use retail, the community as exit liquidity. If you give them equity in the lab entity, then their interests aren't really aligned with the community because they hold equity in the lab, community holds tokens, and the team also presumably holds equity in the lab. So you've got the VCs and the team having equity in the lab. Maybe the team also has tokens, but you get into a weird conflicting set of priorities there. Speaking of competing priorities, it looks like LBRY is telling us that the SEC was both policeman and executioner in the case of their company. They say, since any information given privately to the SEC ends up leaking, we'd like to be upfront about the fact that LBRY Inc. will likely be dead in the near future. We expect the LBRY mission to continue on, but the company itself has been killed by legal and SEC debts. Earlier, I mentioned that a lot of crypto use cases were of ambiguous legality, but not all crypto use cases, including the one detailed in this post. Gaming will be the single most powerful bridge between Web 2 and Web 3. Not only is it the perfect use case for NFTs, it dominates the attention economy. Movies plus TV plus music revenue in 2018 were 50 billion. Gaming revenue was 134 billion. I haven't verified these numbers. If anybody can access some information that disproves these numbers or shows that he cherry picked 2018 because it's not actually true consistently of every year, then let me know. But if this is anywhere near true, then I agree with him. If gaming is really nearly triple movies plus TV plus music, plus it's one of those use cases that's not really illegal, not like a lot of DeFi is. A lot of DeFi is, I mean, we can come up with legalistic arguments to imply that maybe somehow in crypto it's not illegal, but anywhere else it'd be illegal. A lot of DeFi, it'd be totally legal if it was happening outside of crypto. That's not the case with gaming. With gaming, we don't really, I mean, you could figure out ways to turn any kind of gaming NFT into a security or, illegally manipulate it as a commodity somehow or do some kind of weird, banking activities and invoke banking regulations. You could do any of those things, but it's a lot easier, I think, with crypto gaming projects to not end up under the regulatory scrutiny of the SEC or the CFTC or the banking regulators. If it's really this much bigger a revenue producing use case than movies plus TV plus music, then I have to agree with this poster. Maybe gaming is the future of Web3, period. That's not to say we shouldn't keep doing all the things to try to create a more equal economic playing field for all the people of the world. We should keep doing all those things. But maybe instead of creating another 24 DEXs and another, 15 lending platforms and 20 synthetics platforms, maybe instead of doing continual iterations of all those things, we just put some energy into gaming. When I say we should put some energy into gaming, I really mean we should probably put a huge amount of energy into gaming. And it looks like that's what Endmaker is doing with their game, Rogue Galaxies. I didn't know too much about this game, but I listened to their latest AMA today, and I learned some interesting things. The most important of which I think is that this is not going to be a play to earn game, which is interesting because almost every Web3, blockchain, crypto related game, the first thing they tell you is that it's going to be a play to earn game because that's very attractive to gamers. I think virtually every single gamer would rather get paid to game than to go to their actual job. So, obvious reason for people to want to embrace this play to earn thing. The problem is, I don't know if play to earn is really a thing. It seems like you always run into this circular pattern where if it's a play to earn game, people are playing the game because they want to grind away and earn those tokens. And if the tokens have some value outside of the game, if they're like trading in some DEX in some liquidity pool, then there's always this narrative that the token has value because it's, some kind of a scarcity argument, that there's scarcity because it's so difficult to acquire in game. You have to grind so much in the game to acquire the token. But what happens is, at least we've seen some notable examples of the secondary markets for these tokens collapsing. The problem with that is that it's all kind of circular. And if the market for that token collapses, and everybody was just playing the game because they wanted to earn the token, then people stop playing the game. But if people stop playing the game and the narrative for the value of the token was that it's harder in the game, you've got a problem. The whole thing kind of collapses. And we've seen some notable examples of that. So I don't know if this play to earn narrative is really a thing, if it really ends up being a thing. It kind of always ends up feeling a lot more like the Ponzi-nomics thing we see a lot in DeFi. But they're also doing some other interesting things with this game. So this is going to be a space-based game, and the first NFTs will be spaceships. And the development of the game will be modular, with space travel kind of coming first. They wanted to be able to give the community a game as soon as possible, instead of doing the normal game development thing where they take years and years and years, and then they just suddenly launch the entire game and everyone's been rapidly waiting for years. Instead of doing that, they're going to give us modules of the game. So the first module will be a space exploration module where we'll actually be able to use these spaceship NFTs. The second module will be the expedition module, where you'll be able to do things like planetary exploration. And then the third module will be kind of like a social module where there'll be things like larger cities, and you'll be able to do multiplayer things and all those kind of social things. It sounds like the multiplayer is going to be one of the possibilities with the planetary expeditions. On these, when you're exploring these planets, you can do that as either a single player or in co-op play with up to 4 players. When you're in co-op, you could build a crew with different roles. Like one person could be extracting resources like the mining that's mentioned right here, and another person could be like protecting them from, the bad guys while they're mining, that kind of thing. So this is going to be another one of those games where the NFTs, at least this round of NFTs, are going to be kind of expensive. So they're going to have 3 drops of 1,000 of these spaceship NFTs, and these spaceship NFTs are going to be 350 ADA. So again, every time we talk about one of these new gaming or metaverse projects, I always say, do not buy these as an investment. This is not an investment for anybody. These are very expensive game pieces. I would strongly urge you not to ever buy any of these metaverse projects or gaming project NFTs as an investment. These are not investments. Any of these could go to zero. Any of these projects could fail. In fact, I am convinced, absolutely convinced, for sure, that multiple of our Cardano metaverse projects, and we'll just say metaverse and gaming projects as a group, many of those will fail and never deliver what we think they're going to deliver. We will have our Donnas and Orbises of these metaverse projects. So do not buy these as any kind of investment. Only buy these knowing that you're buying a very expensive game piece, and I would just assume you're never going to see that money again. So you should really only buy these expensive game pieces if you're willing to kiss your money goodbye, because we may never get the metaverse. We may never get the game. Having said that, it sounds like if you buy one of these initial NFTs, it'll also include something called a battle pass. They're going to get into more detail later on about what these battle passes do, but it sounds like they'll also have a separate mint for these battle passes, and it looks like these battle passes will qualify if you buy the ship and the battle pass. It'll qualify you for some kind of airdrop of in-game assets down the road. But it's still pretty early with this project. We don't quite know what's going to be what, but it is intriguing that they've completely rejected the play to earn model. They also say that this is not going to be a pay to win game. So you're not going to be able to just go into the secondary markets and buy some super expensive, legendary rarity spaceship and just destroy everybody else in the game and just sort of cruise through the game and finish it, that kind of thing. It sounds like you're actually going to have to do some work in the game to upgrade your NFTs. There's going to be some kind of gatekeeping. You're not just going to be able to go buy an NFT and be invincible, unstoppable force. But I'm really interested to see how this goes. And I'm kind of at this point, I'm pretty convinced that play to earn is not the right path for these Web3 games. I think probably the real utility in crypto and Cardano metaverses and crypto and Cardano games is just to make a fun gaming experience. I think that's what these game and metaverse developers need to deliver to us. I think the utility is in their virtual worlds being fun. I think play to earn, I think it's not really a thing. I think the utility is actually making a fun game. I hope you're having a great week, and I'll talk to you tomorrow.